Vanguard has reduced its exposure to the United Kingdom by £52 billion, raising new questions about capital allocation and funding conditions across Europe. Recent disclosures show that Vanguard has reduced its exposure to the United Kingdom by approximately £52 billion. The decision reflects a broader shift in institutional asset allocation as global managers reassess risk, liquidity, and long-term capital deployment across developed markets. Analysts emphasize that the move is not a full withdrawal from the UK, but a significant re-weighting that affects sovereign debt demand, corporate funding channels, and index-linked capital flows. The United Kingdom has faced a challenging financial environment marked by slower productivity growth, elevated public borrowing needs, and a complex post-pandemic inflation cycle. The gilt market experienced severe volatility during the liability-driven investment crisis, which exposed fragilities in leveraged pension strategies and collateral management mechanisms. While central bank interventions stabilized conditions at the time, institutional investors remain cautious about long-duration exposure and refinancing dynamics in future rate environments. Vanguard's adjustment sits within a larger trend in which international asset managers reduce concentrated country exposures and diversify toward more liquid or multi-region portfolios. Reduced demand from foreign investors increases sensitivity to auction performance, monetary policy communication, and sovereign refinancing windows. For UK authorities, a balanced mix of domestic and international buyers becomes increasingly important as the state funds deficits and future infrastructure needs. Parallel developments across continental Europe show that governments are increasing reliance on short-term borrowing instruments as pension funds shrink and long-duration demand weakens. Treasury bills and short-term notes allow governments to issue debt at lower coupon rates with greater flexibility. However, the approach shortens maturity profiles, increases rollover frequency, and raises exposure to future rate shocks. Should interest rates remain elevated or spike unexpectedly, refinancing costs may rise, creating budgetary pressures. European pension funds once served as reliable long-duration investors by matching liabilities with 20- or 30-year sovereign bonds. Demographic aging, declining fertility, and the shift from defined benefit to defined contribution schemes have reduced the scale and stability of these institutions. As contribution flows weaken relative to payout obligations, pension funds adopt more liquidity-centric strategies, reducing their appetite for long-duration sovereign debt. Regulatory reforms also contributed to this shift. Solvency frameworks and liquidity coverage requirements incentivize holdings of short-term sovereign instruments, which are treated favorably in regulatory capital models. This environment increases competition for treasury bills and reduces natural buyers for longer maturities. The resulting funding structure requires more frequent issuance cycles and broader participation from foreign investors to maintain liquidity. The consequences extend beyond debt management strategies. Shortened maturity structures alter sovereign risk profiles, affect yield curve construction, and influence corporate financing costs that often benchmark against government instruments. Market strategists note that states with deep domestic savings pools are better positioned to manage rollover cycles, while others face greater exposure to international capital conditions. From a global investor perspective, these developments prompt reassessment of benchmark weightings and risk premiums. Vanguard's repositioning illustrates how institutional allocators adjust exposures based on structural funding developments, regulatory environments, and demographic trajectories rather than solely short-term performance metrics. The decision contributes to a broader recalibration of capital flows across developed markets at a time when central banks normalize policy and government balance sheets expand. The interaction between shrinking pension funds, evolving sovereign borrowing strategies, and institutional capital reallocations represents a structural transformation in European funding architecture. Analysts expect governments to continue adjusting issuance calendars, expanding short-term programs, and courting foreign investors as long-term domestic capital pools contract. The stability of this arrangement will depend on whether Europe can rebuild durable savings mechanisms or maintain consistent external participation. Until then, short-term borrowing and selective institutional de-risking are likely to remain defining characteristics of the region's financial landscape.